Hello and welcome. In today's episode, we're going to discuss the fabled business expense write off, or in other words, the general framework for analyzing the tax treatment of all of the various costs that your business spends. When your business incurs any sort of cost, you have to ask two questions: whether it's deductible, and if so, when. Today, we'll focus on whether and turn to when in another episode. You often hear non tax professionals, especially on TV, say, "Oh, I can just write it off. Don't worry about the expense, I'll just write it off." Well, as with anything in the tax world, it isn't quite that simple. Here's a useful framework for sorting through what seems like an easy topic until you start digging in. Start out with everything your business pays for. Step one: which items are truly business expenses versus personal expenses? Examples might be rent you pay for office space downtown compared to the business owner's monthly mortgage on his home. Even if the business owner uses one of the bedrooms only as a home office, you're going to have to divide those total costs between business expenses and personal expenses. Personal expenses are not deductible unless there is a specific statutory provision, such as the one for home mortgage interest. Step two: of the business expenses you identify, which are deductible under a specific section of the tax code, such as for interest, theft losses, charitable contributions, depreciation, and quite a few others. Step three: of the business expenses not covered by a specific code section, which of them are both ordinary and necessary in the conduct of your trade or business? Step 4: does the tax code specifically deny a deduction for any of the otherwise deductible business expenses? Step 5: do you have enough documentation to support your deduction, both that you're entitled to a deduction and the amount of that deduction? Step 6: once you complete all of these steps, you then decide when you get to recover the costs that are legitimate business expenses, that the code permits you to write off, and that you can substantiate. Is it a current expense, a capital expenditure that gets recovered over time? Or is it an inventory cost that gets recovered through an inventory accounting method? Now you can start filling out your tax return. So it's obviously not as easy as just saying your business gets to write off a particular cost. Let's briefly touch on each of these steps just to build the framework you need to walk through when looking at your business's expenses. As always, let's start at the top. Step one: is the cost a legitimate cost of running your business? Just because your business paid for something does not automatically make it a business expense, no matter what you might hear on TV or in the movies. For example, your business pays for a family ski trip to the mountains. You happen to have a client in the area, and the client joins the family for dinner one night. Can the business just write off the cost of the entire family vacation as a business expense, or at least the cost of the dinner? What if the client also is the business owner's former college roommate and you never even discussed business at dinner? What if instead this is a potentially valuable but elusive business prospect you've been chasing for a couple of years? You heard that she only likes to work with family oriented people, and you are surreptitiously using your family members as props in your wooing of this prospective client. The family vacation is merely a business ploy. Now, is it deductible? I'm not giving you answers here because that isn't the point of our discussion. These are inherently factual issues, and the key is being able to attack your own unique set of facts using the analytical tools that we discuss. Step 2: Once we identify our business expenses, the next question is whether there is a statutory basis for writing off a given cost. Let's start with one of the foundational rules that all tax professionals either are or should be able to recite in their sleep. A receipt is presumed to be income unless the taxpayer can show otherwise. But deductions are a matter of legislative grace. As the Supreme Court has said, a taxpayer seeking a deduction must be able to point to an applicable statute and show that he comes within its terms. Luckily, the tax code makes it relatively simple to find the statutory authority you need for the most common business deductions. Most of them are grouped together in sections 162 through 199A, and then in a few other places. The broadest and most commonly used provision is Section 162, which permits a business to deduct all of its ordinary and necessary business expenses. But let's come back to that one. The next handful of code sections basically catalogs the most common expenses your business may be able to deduct. As you see from this list of examples, the tax code gives you specific authority and the accompanying rules for deducting things like interest, taxes, business losses, bad debts, cost recovery of business assets that you'll use for more than 1 year, charitable contributions, research and experimental costs, the costs of starting up a new business, and many more. You may want to scan the table of contents of the tax code to become familiar with the many specific deductions that are available, as well as where to find the rules governing each of them. Step 3. Step 3 takes us back to the more general provision that we set aside, Section 162. Section 162 is the catch all provision for deducting business expenses. It permits a company to deduct any ordinary and necessary business expense. Does this mean that you get to deduct everything your business spends that isn't already deductible as interest, a charitable contribution, some sort of loss, depreciation, or one of those other specific provisions? No. To qualify for a deduction under this catch all category, you have to show two separate things. First, the expense has to be ordinary. The Supreme Court says that in this context, ordinary means that the cost is normal and customary within a particular trade, business, or industry. Does this mean that your business has to incur this type of cost frequently? Nope. You just have to look at the expense in the broader perspective of your business's trade or industry. For example, if you get sued by a customer for something that is pretty common in your industry, you might be able to deduct all of the costs associated with that litigation, lawyer's fees, the cost of a settlement or judgment, and similar costs. Even if your company has never been sued for anything at all before and you hope to never be sued again. A business expense is necessary if it's appropriate and helpful for the development of the business. Again, this is a pretty low bar to pass. The IRS agrees that an expense does not have to be essential or indispensable to your business to be necessary. It just has to be helpful. But there are situations in which a company incurs a cost that is so out of the ordinary that you may have to defend it against an IRS challenge. An example is paying the debts of another company that is critical to your supply chain and that might go out of business otherwise. Step 4. So now I have a bucket of costs that plainly are business costs that I can show is not out of the ordinary for members of my industry and that clearly are helpful to my business. That means they're deductible business costs and we can just move on, right? Well, not so fast, my friend. Because deductions are a matter of legislative grace, there are specific types of costs that many, if not most, businesses incur that are never deductible at all, ever. Most of these are because Congress has decided that it would be against public policy to permit a deduction for certain things. So it has not graced those costs with a deduction. Here, we're talking about things like illegal bribes and kickbacks, certain types of lobbying costs, fines and penalties, certain types of entertainment costs, and excessive executive compensation. There are others, but this gives you a sense of how the tax code is used to both encourage and discourage certain types of behaviors and expenditures by businesses. Step 5. Even if your cost is undeniably a business expense that falls squarely with one of the provisions for which Congress has extended its legislative grace, you have to be able to prove it to the IRS. The tax code specifically requires all taxpayers to maintain adequate books and records to substantiate their tax positions, including things like deductions. If you read through the case law, taxpayers, especially small businesses, lose a substantial number of their cases based on not being able to substantiate the deductions or other positions they've claimed on their tax returns. Failing to maintain records adequate to support your tax position just makes things too easy for the IRS. IRS Publication 583 provides a useful discussion of the types of books and records the IRS expects you to keep to support the various items on your tax return, including expense deductions. Step 6. So we're done, right? I get to deduct all of my business costs right away using whatever my method of accounting is, right? Not so fast, my friend. There is a little matter of Section 261 of the tax code. It basically says that no matter what you conclude in applying Section 162 or its sibling sections to a legitimate business expense, you can only recover those costs over a period of multiple tax years or when you eventually sell the property if the costs are expected to generate taxable income over more than one tax year. Remember our very first lesson about the clear reflection of income doctrine and matching expenses with related items of income. Well, as they used to say in ancient Rome, there's that road leading right back here. But that's a story for another day. The bottom line for today is the next time you hear someone flippantly say that they can just write off something on their taxes, ask them if they're familiar with FedTax 101. That's all for now, and as always, keep checking back for more.